I'm not going to speak to investor behavior because I don't understand it. I don't own a TV. I'll speak to fundamentals, which is to say, global demand for industrial materials is weaker than many
Mm.
people expected. If global demand recovers, you will see a rock and roll market in raw materials, unrelated likely to the gold market, more related to the fundamentals of supply and demand. If you don't, you will ultimately see a rock and roll market in some commodities, copper and oil among them, because of the lack of sustaining capital and new projects. If you're an investor, probably not for the near term. If you're a speculator, maybe. We talked before, Danny, you and I, about the fact that bull market behaviors are fairly consistent. And in precious metals, when the momentum is established by gold, and that momentum justifies the narrative, when the generalist investors come into the precious metals market, silver begins to outpace gold.
Mm.
And that outpace became dramatic, I guess, in the last 90 days. I would take issue with the statement that silver is at all-time highs. It's at all-time nominal highs.
Mm-hmm.
That doesn't take into account the deterioration of the purchasing power of the dollar. It's important to note that if you agree with my inflation numbers rather than the CPI, that in a real sense, silver likely has further to run. I think that's very, very, very important. I think part of the near-term strength, is, of course, momentum and meme. I'm sorry. Part of the strength and the strength that you're seeing in some of the rest of the commodity complex probably has to do with artificially low interest rates, the decision to cut interest rates again, and the risk-on appetite of institutional investors, which suggests that this might not be a time even for traders to pile on. But I believe, Danny, and you and I have talked about this before, that this precious metals bull market is really one for the ages, one reminiscent of the 1970s. And if you talk to me about the price of silver 2 years from now, or 4 years from now, or 5 years from now, I think in nominal terms, which is to say US dollar terms, it's much higher, not merely higher. The question is what happens to it over the next 3 months or 6 months. And the honest answer to that question is I have no earthly idea. That's not how I trade.
Price depends entirely on what you measure it against. When costs are calculated in dollars, essentials like housing, healthcare, and food appear expensive. But when measured in gold, many of those same necessities have become cheaper over time. Since 2000, gold has compounded steadily, preserving purchasing power while fiat currencies declined. This reframes the entire investment discussion. Gold has not surged irrationally. It has simply maintained value. The dollar, by contrast, has quietly lost ground. Viewing assets through this lens reveals why precious metals remain central to long-term capital preservation strategies.
I think that's right. I've made the observation recently, because I've observed recently, that if you had saved in gold rather than the US dollars, by the way, I've maintained liquidity in dollars, but saved mostly in gold. If you had done that since the year 2000, you would be struck by how cheap many things are. Housing, cheap. Rent, cheap. Health insurance, cheap. Groceries, cheap. If you measure those items in dollars, they feel expensive. But if you measure them in gold, all of a sudden they feel cheap. Gold has escalated at about 9% compounded. I suggest that gold has maintained its purchasing power while the dollar has, in fact, lost its. And that, I think, explains part of your chart. I think you could have a discussion about oil. You could have a discussion about copper. You could have a discussion about a lot of things against the golden constant as opposed to against the dollar. And you would find that the price of many things over the last 25 years is lower had you maintained your savings in an instrument that maintained your purchasing power rather than the US dollar or any other fiat currency for that matter.
Today's precious metals rally is not speculative excess. It is delayed adjustment. For decades, gold underperformed while global debt expanded. That imbalance is now correcting. Governments face obligations that far exceed realistic repayment capacity, leaving inflation as the only viable escape. By honoring debts nominally while eroding their real value, policymakers reduce the burden silently. Gold responds naturally to this arithmetic. This is not a cyclical anomaly, but a structural shift. The metal is reacting to monetary pressure that has been building for decades, not months.
You have me a bit out over my skis in terms of that question, but I'll do my best. I think a lot of the move that we've seen in precious metals had to do with merely historically making up for lost time,
Hmm.
which is to say, I'm not going to suggest that gold broke new ground in the last 2 years. I'm going to suggest that it made up for underperformance
Hmm.
that occurred in the last 30. Gold was, I think I described it the first time you and I talked a couple of years ago, gold was a coiled spring, and the spring has begun to come unsprung. And that is, I think, primarily a monetary, um, circumstance. We talked before about the arithmetic of America, the fact that our federal government's on and off balance sheet liabilities, including the net present value of entitlements, exceeds $150 trillion, as opposed to the private net worth of all Americans, as estimated by the IRS, at $167 trillion. There's not a lot of room left. The only way that you get out of that trap, if you are our society, is you honor the nominal value of our obligations while you inflate away the net present value. And that's precisely what's happening. And I would suggest that's precisely why gold is moving. The other part of the equation that you describe as the perfect storm is in many senses unrelated. The move that you're beginning to see in industrial materials, you haven't seen it in gold yet, to be sure. I'm sorry, you haven't seen it in oil yet, to be sure.
Mm-hmm.
But that move is different. That has to do with the ascent of humankind. Very poor people around the world becoming less poor materially. And also it has to do with 3 decades of underinvestment in the means of production. We haven't invested anywhere near enough money in the copper business, as an example. And there is no way in the next 5 years that we can invest enough money that we can handle an impending shortage. I'm actually surprised by how tame the copper price response has been to fundamentals, which is to say in 2025, there was an underlying supply deficit. And then exogenous events took away another 7% of supply. Grasberg, Cobre Panama, Kakula, the idea that the silver prices, the copper price is only up 6 or 7%, when you take away 7% of supply from an already undersupplied market is amazing to me. I would have expected a 20 or 25% price response. And I think we'll see that. I don't believe, Danny, that we are right now in a broad-based industrial materials bull market. But I think we will be in 2.5 or 3 years. Conversely, I believe we are in a precious metals bull market. And the inflationary aspects of a precious metals bull market will also begin to play into the industrial materials bull market, because inflation will raise the capital cost of increasing the supplies that would be needed to tamper the prices associated with supply shortages. I agree with you that we are in for 10 years that will be much more reminiscent of the 1970s than anything that we've seen since. As to cyclicality, Danny, you're way better with charts than me, so I'm going to defer to you.
Beyond precious metals, industrial commodities face a separate but equally powerful force: supply constraints. Years of underinvestment have left critical materials like copper vulnerable to shortages. Even modest disruptions now cause outsized stress. Demand growth from electrification, infrastructure, and emerging markets continues, while supply expansion remains slow and capital-intensive. Prices have not yet fully reflected this imbalance. When demand recovers meaningfully, the response could be sharp. Unlike gold, these markets are driven less by currency concerns and more by physical scarcity and production realities.
I'm not going to speak to investor behavior because I don't understand it. I don't own a TV. I'll speak to fundamentals, which is to say global demand for industrial materials is weaker than many people expected. If global demand recovers, you will see a rock and roll market in raw materials, unrelated likely to the gold market, more related to the fundamentals of supply and demand. If you don't, you will ultimately see a rock and roll market in some commodities, copper and oil among them, because of the lack of sustaining capital and new project investment. You can have weaker demand, which you have right now, in the face of dramatically weaker supply, and still have price rises. Sort of like the old Purelator oil filter commercial. I don't know if you're old enough to remember that, where the mechanic has a can of has an oil filter, pardon me, and has an engine and says, "You can pay me now," meaning the can of the Purelator, or "You can pay me later," meaning a blown engine. That, to me, is sort of where these major commodity markets are. Whether it happens 2 years from now or 5 years from now, sort of doesn't matter to me. It's going to happen, absent World War III, and it's going to be dramatic. Ultimately over 20 years, perhaps that's true. When wars take place, listen, wars destroy wealth. Let's get that on the table. So be very careful what you wish for in any regard.
Many investors ask why silver mining stocks have not dramatically outperformed silver itself. The answer lies in structure and quality. Most silver production comes as a byproduct of base metal mining, not from pure silver mines. Many primary silver companies struggle with high costs, weak management, or inefficient capital allocation. As a result, gains in silver prices have not fully translated into profits. However, sustained prices above key thresholds could change that. When margins expand consistently, stronger operators may finally deliver earnings surprises the market cannot ignore.
And if you believe, like me, that the gold price goes higher, perhaps not in the next 6 months, but that the gold price goes materially higher, that adds a little extra luster to that chart.
Yeah, definitely some more added torque. Rick, one of the things that's been, I mean, questions from my audience is, why haven't the silver miners risen? Well, they have risen, but they haven't outperformed the silver price, much like GDX hasn't. Well, GDX has outperformed the gold price. GDX was up 140%, I believe, 130%. Gold was up 70%, so a 2x torque, 2x multiplier on the gold price. But silver was pretty much, around the same 130, 140% price move. Or SIL was in the same 130, 140% price move relative to silver. So
I think there's two reasons for that. One is that many silver speculators express their preference in the paper silver market, in the silver's future market, or in the physical market. In the gold side, the fear buyers are in the physical market. The greed buyers are in the share market. We haven't seen the greed buyers in the silver stock space. The second fact is much more pernicious. Most of the silver mining companies are lousy companies. Most of them are meme stocks. It is a truism that only 18% of primary silver supply comes from silver mines. The rest comes from recycling, copper mines, lead mines, zinc mines. And those companies have much, much, much lower all-in sustaining costs for silver, because most of the mining cost is paid for by their primary metal. Those two factors, the fact that most production comes as byproduct, and the fact that most silver miners trade as proxies for silver and are lousy companies, is, I think, the reason for the lack of performance in silver mining companies. There are companies, as an example, Peñoles, pretty high quality companies, Buenaventura, that have performed very well, Pan American Silver. But most of the intermediate silver stocks have been challenged in terms of translating higher silver prices into higher free cash flows. Their gold peers, witness Agnico Eagle, have been much less challenged. The margins from increased gold production, from increased gold prices, have fallen through to the bottom line. My suspicion is that the translation of commodity prices to free cash flow and valuations is a lagging indicator. So I would suspect that if we maintain silver prices north of 50, it doesn't need to be north of 80. If we maintain silver prices north of 50, you will begin to see margin escalation throughout the silver space. And when you deliver earning surprises as a consequence, you will see share price performance among the reasonably efficient silver companies. And the market has begun to anticipate this. The market, as an example, in Coeur or Hecla, silver proxies, but companies that have not historically been efficient operators or good allocators of capital have done quite well this year. I would suggest not as much on trailing results as on anticipation of the fact that they will deliver the same sort of margin increases that the Newmonts and the Agnicos and the Kinrosses have delivered in the gold space.
What about the cost side of things? What about the price of oil being where it is today? Because if you look at a chart, I'm not going to pull it up now, but look at the chart of silver to oil. I mean, so the silver to oil ratio is sky high. Isn't that a proxy for their margins as well?
That's helpful to all miners. A major part of your cost structure is energy, and energy prices are extremely cheap. That's partially offset by the increasing rapaciousness of governments. The social rents in mining have been soaring for the last 2 years. Royalties, free carried interest, taxes, all that kind of stuff. So some of the benefit that the industry has seen from declining energy prices has been offset by the increasing rapaciousness of governments around the world. The other benefit that the miners are enjoying, of course, as a capital-intensive business, is artificially low interest rates. This is a capital-intensive business. If the cost of that input, which is to say capital, is lower than it would otherwise be, that benefit flows through to the bottom line, and it has been.
Mining economics are shaped by energy costs, capital access, and government policy. Low energy prices and cheap financing have supported margins, but rising taxes and royalties increasingly offset those gains. Despite this, the long-term outlook remains constructive. Precious metals appear positioned for a decade resembling the inflationary cycles of the 1970s. Whether driven by monetary dilution, underinvestment, or geopolitical strain, the outcome favors scarce, tangible assets. Timing short-term moves remains difficult, but structurally, the direction is becoming harder to ignore.